Do not put too much emphasis on what's happening here on your screen on this first day of December. Why? Because the month of November looked absolutely dismal until it pulled a rabbit out of a hat. A huge rally last week fished the Dow, the S&P, and the Russell out of deep red water and hauled them onto dry land. The Dow ended up, okay, it was a fraction, up 1/3%, and the S&P up just 0.1%, but that let them claim their 7th straight month of gains. The Russell up 0.8%. NASDAQ did rally, but not enough, so it broke a 7-month win streak, ended down about 1%, but it had been down 4% earlier in the month. Speaking of the tech-heavy index, its star stock Nvidia is moving higher by 1% right now after the AI chip king CEO Jensen Huang announced a Cyber Monday expenditure of his own. Nvidia investing $2 billion in software design maker Synopsys, which is up 4.5%. So the two are going to jointly develop tools that can design products for industries using its AI technology. With Nvidia sitting right now at about $178.91, listen, was last month the right time to lock in some profits, no matter how hard a decision that might have been? Well, today at a financial conference in Tokyo, SoftBank CEO Masayoshi Son said he was in tears last month when he decided to dump his entire stake of the high flyer. Listen.
I wish to have unlimited money. I respect Jensen. I respect Nvidia so much. I don't want to sell a single share. I just had more need for money to invest into OpenAI, invest into our opportunities. So I was crying to sell Nvidia share.
Got emotional. He was crying when he sold. All we know is that Masa Son sold it sometime in October. Hopefully that was around October 8th when it hit the monthly high of $192. It dropped after that, but then went as high as $207 in November. But this brings to the forefront the question of whether it's time to move some assets around, just like Masa Son did. And if so, where can you achieve a balance of both growth and yield that may involve certain active ETFs? Let's get right to the floor show to find out more about that. Jay Jacobs is BlackRock's U.S. head of equity ETFs. Active ETFs. You can capture all of the high-tech names, but you can also at least protect to the downside, correct?
Well, that's right. When we look at active ETFs, it's really the idea of bringing portfolio managers that are making decisions of what stocks they like, what exposures they want, into the convenience of an ETF. So one of the areas where we've seen just tremendous growth this year is in income-oriented strategies. If you just buy a dividend S&P 500 fund, you might only be getting about 2.5% yield. But if you do an options strategy ETF like BALI, B-A-L-I, you can get yield around 7.5%, about 3 times higher. And that's what an active portfolio manager is doing to generate income with participation in large cap U.S. stocks.
Okay, so let's be clear. It's a premium income active fund. Mm-hmm. And what it involves is you buy outright stocks,
yep,
S&P futures, but also covered calls. So you are actively managing, or you've got 2 active managers in some of these cases, and they are buying covered calls. So they're capturing an option strategy to do exactly what for the investor?
That's exactly right. So you can sell away some of your upside participation in pursuit of income. So basically you're saying, you know, if the market rallies a ton, that's great. I'm willing to give up some of that upside in exchange for income today. That's how you can get some higher yield. But by buying S&P futures, we can actually hedge some of that risk so that you get to participate in more of the upside of the markets.
In BALI, B-A-L-I, your top holdings reflect what a lot of people have in their portfolios. A lot of the Mag 7 names, Nvidia, Microsoft, Apple, Amazon, Alphabet. You also have in there some consumer names, Johnson & Johnson and Walmart. So it is somewhat balanced, not so when it comes to the case of the second active fund that you talk about, which is BAI. That is very technology heavy.
That's right. So BAI is an actively managed AI fund. When we hear so much about all of the chip makers, all the large language model developers, data centers, I think a lot of investors are saying, who can guide me through this? Who can navigate this AI scene that seems to be evolving so quickly? That's why we brought out BAI, to have an active manager that can decide these are the stocks where we have the most conviction for the future of artificial intelligence.
Okay, so over 1 year, up 31%, over year to date, up 27% or so. But if, let's just say I pick Snowflake, for example, and because Snowflake is in it. Snowflake is a SaaS company and also very involved in AI. If I had just put all that money in Snowflake, Snowflake is up 63% year to date. So why wouldn't I do that?
Because you can get a lot more diversification in an ETF. Yes, maybe you pick the right stock this year, but next year maybe you pick the wrong stock. If you're just trying to play the AI trade with one individual stock at a time, we're looking at dozens of stocks that are participating in AI, large language models, software companies, data centers, even power companies that are supplying power to these data centers. It's a much larger value chain. Diversification, I think, is key in any theme that's moving as quickly as AI.
Well, let's talk about the markets today on this first trading day of December. We've got the Dow down triple digits, same with the NASDAQ. Everything's getting hit today. Any idea of how this may play out like November did? Because November's green on the screen at the end of the day, at the end of the month, was a surprise to a lot of people who thought, you know what, the win streak for the Dow and the S&P is done.
Well, all's well that ends well, I suppose. November didn't feel amazing, but we ended up in the positive. I think what really gives us a lot of confidence is that the markets are up a significant amount this year, double digits, but it's being driven by earnings, not by valuations necessarily. About
that makes you feel
of this.
better that it's earned.
This makes us feel better because this means that companies are growing. They are becoming more profitable, and that is the lion's share of what's driving prices upwards. We've had a good earnings season. I think if we continue to have a strong macro environment heading into year end, we could still be very optimistic.
Well, let's go to that macro environment. We have the big Fed meeting for December next week, the 9th and the 10th, and it's widely expected that there will be a quarter-point rate cut by the FOMC, the Federal Open Market Committee, when they meet for their policy. So 87.6% odds, definitely a 25 basis point cut. So does that signal, because you never know with the market, which has a herd mentality, does that signal, okay, great, that means that's the catalyst for stocks to go higher, or does it signal maybe we're in a bit of trouble with the economy and we need the stimulation?
Well, the interest rate cuts are largely priced in at this point. I think it'll come down to jobs numbers. And frankly, this is December. This is consumer season. So what are some of the consumer data points that are coming out around Black Friday? That will give a lot of confidence. Now, if you look at this year, consumption hasn't been a huge driver of GDP in the United States. It's been a lot more on the CapEx side. So it'll be really interesting to see, can the consumer really rebound in Q4?
And again, when you're looking at the overall picture here of a balanced portfolio and you think to yourself, what's going to happen in 2026? We are coming off, if things continue to go the way they are, year to date, the Dow, S&P, NASDAQ, and Russell are all double-digit percentages, just like last year and the year before. Everybody said, we can't see 3 years in a row of that. That's just too incredible for the bulls. Do we get another year like that?
Well, again, we've seen strong earnings. We're coming into an era where we're going to see more rate cuts, most likely. There's a lot of optimism around the AI trade. I think this is going to be 2026 will be a year where we're optimistic, but people need to be nimble. I think this is where active management can provide a ton of value to navigate where we are seeing the markets up, but we're also seeing a lot more dispersion across stocks. There's some bigger winners and some bigger losers, and being able to play the stock markets the right way can really help drive investor returns in 2026.
And we're getting some economic data this week that are truly very important, especially Friday. We're getting jobs numbers from the ADP on Wednesday, but very interesting to see what may vary, Thursday rather. Thursday is the ADP, but Friday we get September, again, rear view mirror, but PCE, personal consumption expenditure numbers. The core PCE is what the Fed looks at for inflation. And it is expected to come in pretty much the same as the prior month for August. So inflation, how do you play that into the picture?
Well, I think if we see a lower inflation number, or as expected, that could help support why we have rate cuts coming, and that could end up bringing down real yields. So at the end of the day, I think if we see inflation is tame, if the jobs numbers are strong, we know we've had the strong earnings, we get a strong consumer piece, we could end up in a really Goldilocks end of year environment.
Listen, the 10-year just jumped to 4.1% just a second ago. So yields are continuing to rise. And it kind of makes sense that the markets go down, at least at the moment. Yeah, it just touched it a second ago. All right. Thank you very much. Good to see you.
Thank you.
Jay Jacobs.